Hello everyone, it's me Umar Farooq. Welcome to the of Money. Today we are going to understand candlestick analysis. So let's start. Welcome to Candlestick Chart Analysis. In this section, we are going to understand how candlesticks actually works, what they tell us about buyers and sellers, and how different candle patterns can be interrupted in real market situations. Candlesticks may look like simple green and red rectangles, but each one contains a complete story about price movements during a particular period. Instead of simply memorizing patterns names, our goal is to understand the psychology behind them. By the end, you should be able to look at a candle and ask the right question: where did price open? How high did it go? How low did it go? Where did it close? Who appeared stronger, buyers or sellers? And most importantly, what was happening around the candle? Remember from the beginner, a candlestick is a clue, not a prediction machine. The market doesn't come with a remote control, unfortunately. Anatomy of candlesticks. Candlesticks is built around four important prices: open, high, low, and close, commonly called OHLC. The real body represents the distance between the opening and the closing prices. If the close is above the open, we generally call it as a bullish candle. If the close is below the open, it is bearish. The thin lines extending above and below the body are called the shadows or wick. The upper wick shows the highest price reached during the period, while the lower wick shows the lowest price reached. Think of the candle as a tiny move compressed into a picture. Price may have started at one level, moved aggressively upward, fallen sharply, recovered again, and finally closed somewhere completely different. The candle captures that entire battle. A long body can indicate stronger directional movement, while long shadows can show rejection of higher or lower prices. But don't interrupt every week as a secret message from the market gods. Always consider the surrounding price action. What is a candlestick chart? A candlestick chart is simply a graphical representation of price movement over time. Every candle represents on specific time frames. On a 5-minute chart, one candle represents 5 minutes. On a daily chart, one candle represents one trading day. On a weekly chart, it represents 1 week. The same for prices: open, high, low, and close. Allows us to see not only where price is moving, but also how it is moving. A large bullish candle suggests strong upward movement during that period, while a large bearish candle shows stronger downward movement. Smaller candles can indicate hesitation or consolidation. One important lesson here is that different time frames tell different parts of the same story. A short-term bearish candle doesn't necessarily mean that the larger trend has become bearish. It's like watching one scene from a movie and deciding that you already know the ending. So always understand the time frame you are analyzing and use the broader market context whenever possible. Bullish versus bearish candles. A bullish candle forms when the closing price is higher than the opening price. It tells us that buyers managed to push the price upward during that period. A bearish candle forms when the closing price is lower than the opening price, meaning sellers had greater control by the ending of the period. But there is a major mistake beginners often make. They see green and immediately think buy, or the red and immediately think sell. That's not how it's works. Green candle only tells us that price closed higher than it opened. A red candle only tells us that it is closed lower. The real information comes from the candle size, its wicks, its location, the trend, support, resistance, and the happens afterwards. A large bullish candle after a breakout can mean something very important, different from a large bullish candle after a already extended bullish trend. Candlesticks describes what happened. They don't guarantee what happened next. Spinning tops and doji formation. Now we come to two important examples of market indecisions: spinning tops and doji candles. A spinning top usually has a small real body with the upper and lower shadows. This tells us that price moved in both directions, but neither buyers nor sellers were able to establish complete control. You should say the market had an argument and nobody won. A doji is formed when the opening and closing prices are very close to together. There are several variations, including long-legged, dragonly, and groundly doji formation. The important concept is that market travelled during that period, but immediately entered to where it started. This can indicate uncertainty, especially after a strong trend, but never trade a doji blindly. A doji in the middle of a sideways market may mean very little. A doji appearing after a powerful rally near resistance may deserve much more attention. The following price action is often essential for confirmation. Deep dive. Marubozu Patterns. Marubozu candles represent strong directional movements. A bullish Marubozu generally opens near its low and closes near its high, with little or no visible wick. This suggests that buyers maintain significant control throughout the period. A bearish Marubozu is the opposite. It generally opens near the high and closes near the low, showing strong selling pressure. These candles can be particularly interesting when they appear during breakouts or strong trends, but again context matters. Imagine a stock that has already risen dramatically and suddenly produces a massive bullish candle. Chasing that candle simply because it looks powerful can be risky. On the other hand, a strong bullish Marubozu breaking of a well-established consolidation area in a provided a very message. The lesson is simple. Strong candles show strong movement, but strong movements does not automatically mean strong future performance. Always consider where the candle appears and what happens next. Types of single candlestick patterns. There are many single candlestick patterns, but the goal isn't to memorize every name in a text box. The important thing is to understand the information contained inside the candle. Marubozu candles can indicate strong directional conviction. Spinning tops can indicate uncertainty. Doji formation can show that the opening and closing prices were very close. Hammer and hanging man structures can show rejection of lower prices depending on their location. Shooting stars can show rejection of higher prices, but a pattern's name is less important than its context. For example, a hammer after a significant decline near support can potentially indicate that sellers pushed price lower but buyers stepped in strongly. The exact same shape appearing randomly in the middle of a range may have much less significance. So don't become obsessed with finding patterns. Learn to understand the story behind them. The candle is simply a visual evidence of what buyers and sellers did during the period. Paper umbrella pattern. The paper umbrella structure is characterized by a relatively small body and a long, or lower shadow. Two important variations are the hammer and the hanging man. A hammer generally appears after a declining and can signal rejection of lower price. Imagine sellers pushing the market downwards, but then buyers enter the recover much of that decline before the candle closes. That creates the lower wick. The hanging man has a similar structure but appears after an advance. In that situation, the long lower shadow can warn that selling pressure appeared and even through price recovered before the close. The key point is that the structure alone isn't enough. Location determines interruption. A hammer at the bottom of a decline can mean something very different from the same candle appearing after a strong rally. Confirmation is also important. A candle gives you information, confirmation gives you more evidence. Enhancing trade reliability. This is where candlestick analysis becomes much more powerful. Never depend on a candlestick pattern in isolation. Combine candles analysis with the trend, market structure, supports and resistance, volume and other relevant indicators. Suppose you find a hammer near a major support level after a significant decline. That's more interesting than finding a hammer randomly in the middle of a sideways market. Similarly, a shooting star near major resistance can deserve more attention than one appearing without any clear structural significance. Volume can also provide additional context. A strong price movement accompanied by increased participation may provide different information from a similar movement occurring with a very low volume. The goal isn't to add 20 indicators to your chart until it looks like a spaceship control panel. The goal is to use a few useful pieces to evidence that the answer specific questions. Even the best looking patterns can fail. Good analysis isn't about being right every time, it's about managing uncertainty when you are wrong. Shooting star pattern. The shooting star is a bearish single hand candle pattern that generally appears after an upward move. It has a relatively small real body near the lower portion of the candle and a longer upper shadow. The story behind the candle is important. Buyers initially pushed the price significantly higher, but sellers eventually appeared and forced the price back down before the candle closed. The long upper wick therefore represents rejection of higher prices. A shooting star can become particularly interesting near a major resistance zone or after an extended backward movement. But once again, don't look at candles and immediately press button. Wait for confirmation. If the following price action moves lower and confirms weakness, the bearish interception becomes stronger. If price immediately breaks higher, the shooting star may have failed as a reversal signal. This is why professional analysis focus on probability rather than certainty. A shooting star doesn't say the market must fall, it says higher prices were rejected here, so attention and the distinction is extremely important. The biggest lesson from candlestick analysis is that no signal candles should control your decision. Learn the anatomy first, open, high, low, close, body and wicks. Then understand bullish and bearish candles. After that, study formations such as Doji, spinning tops, Marubozu, hammers, hanging man and shooting star, but always connect those patterns to the higher picture, trend, market structure, support, resistance, volume and confirmation. Most importantly, remember that technical analysis deal with the probability and not certainties. The market can also surprise you, so don't try to predict every single candle. Instead, develop a process that helps you recognize favorable conditions, understand invalidation points, and manage risk responsibility. A candlestick is a clue, not a command. Once you start reading of a story of a buyer and a seller behaving rather than simply memorizing their names, charts becomes much easier to understand. This is the end of Candlestick Chart Analysis. Thank you for watching. Stay tuned for next video on Saturday 6:30 p.m. Bye.